My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy money starts now. Having control of your finances is one of the most important things you can do over your lifetime. The problem is most people have little to no control or liquidity when it comes to accessing their capital, money that they've already saved. At Legacy Money, we're always working and striving to help you take control of your finances. So it's available to you for emergencies, opportunities, or whatever you may want or need it for, whether it be for your family, lifestyle, or business. That's why I put together this video to show you how to create your own private family banking system, so you never have to depend on the banks or the government for money again. I'm Barry Page, back with another Infinite Banking training to help you so you understand how your money flows and you can take control. You'll want to watch this entire video so you can refer back to it whenever you want to. So before I forget it, go ahead and hit the little subscribe button and make sure you might want to click the little bell so you'll be notified when I come out with new videos. All right, let's get started. First, you should know that I personally have been practicing infinite banking for over 16 years when I first read the book, Becoming Your Own Banker, and I met Nelson Nash. Since then, I've helped literally hundreds of clients, families, take control of their finances by practicing infinite banking. And over the last 10 years, I've been training other agents and advisors how they can use infinite banking and the proper way to use infinite banking to build plans for their clients. In this video, I'll be covering 3 secrets that the wealthy understand and you'll probably want to know about money. Number 1, control is the most important thing that you can have when it comes to your finances. Number 2, using other people's money creates leverage so your dollars can work harder. And number 3, the velocity of money. Do what the banks do and turn your money, keep your money working. All right, we'll get started. I'll share those secrets with you. Okay, let's get started with the training. How family banking works, unlocking the infinite banking concept. Here's a quote about banking. It is well enough that the people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning. Henry Ford said that 100 years ago. I believe that people are starting to wake up and they're learning more about the Federal Reserve and how our banking system works. Here's another quote from the original family bankers, the Rothschilds. Let me issue and control a nation's money, and I care not who writes the laws. That's from Mayor Amstel Rothschild. So what I'm about to share with you is a way that you can take control of your own money so you never have to depend on the banks or the government again. Our mission, the mission of infinite banking practitioners, is to build the 10%. The foundational power of the 10% is found in the similarity of our thought patterns. We're people of like minds who are empowering an idea that we truly believe can change our environment, not only for our own good, but also for the good of our fellow man. Though we are but a remnant, we represent an exodus, a way out. This educational training is based on the best-selling book from Nelson Nash. It is not meant to be a replacement for this book. It is merely a video training to help you further your education. I am an infinite banking concept authorized practitioner. I have been since the program started, and this is all based on the book that Nelson Nash wrote. This is a picture of me doing some training for other agents and practitioners at the Infinite Banking Think Tank. And we hold this think tank annually, and I go there every year, as I have for over 15 years, to learn myself and to share this knowledge with others. So what is the infinite banking concept? It works through a custom-designed, dividend-paying, participating whole life insurance policy from a mutual life insurance company. Now that's a mouthful because all of those things are important. First, it's custom designed. It's dividend paying, participating whole life insurance. So there's a lot of companies out there touting whole life insurance, but participating, dividend paying is the key word. And from a mutual life insurance company, not a stock-based company. These policies function like a bank by paying premiums, which we'll call making deposits, and taking loans, borrowing money. And these specially structured policies allow access to the capital, which is the available cash value. The infinite banking concept is not a bank. It's a thought process that represents a major paradigm shift. That's a quote from Nelson Nash. And so why practice infinite banking? Well, it makes sense and sense. If you owned a grocery store, where would you shop for groceries? At your store or somewhere else? You have a family. You love your family and you want financial freedom. Maybe you have a business. You need cash flow. You want access to capital. Maybe you're just fed up with the banks, the Federal Reserve, and you're sick and tired of paying interest and fees to others. You want to protect and grow your wealth. You're concerned about your money. When you own an IBC designed, dividend-paying, participating whole life insurance policy from a mutual company, you own and control the mechanism for banking. Banking is a business. So if you've ever dreamt of starting your own business, could you think of any better business that would be better than having your own private family bank? Banking is a process. It's not a physical bank with overhead costs and headaches. It's not a product. Banking is a process. Finance. So the very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. That's a direct quote from Nelson Nash, the author of the book, Becoming Your Own Banker. So, opportunity cost. You may or may not have heard this term. Before any capital outlay, before you spend any money, you first should consider the cost. And not just the cost, but the opportunity cost as well. Remember, it's not just what you pay for, but how you pay for it. That's a quote from Don Blanton. So what is cost, including the opportunity cost? So I pulled up a calculation here that I've already done for you, but just to simplify things in the essence of time. If you had $10,000, whether it be an expense or whatever it was, and you were earning on maybe an investment, wherever your money was stored, you were earning 5.25%. We're going to project that out for 30 years. So if you look here, the calculator has already done that, and the total at the end of that 360 months, 30 years, is $48,141. So if your expense of $10,000 had been invested at 5.25% annual percentage rate and it compounded for 30 years, you would have earned $38,142 in addition to the original purchase of the $10,000. So this is the opportunity cost. Not only did that expense, that cost you $10,000, it also cost you over time the $38,142 for a total of $48,141 over that time period, or 142. So, wealth transfers. Every dollar that we do not save is consumed, either by our lifestyle or it's transferred away. Some transfers of our wealth are avoidable. Others we can only minimize. But that's what we're trying to do here, is avoid or minimize these wealth transfers. The problem is that the items we purchase are financed by other banking institutions. This means that the interest portion of every dollar spent is perpetual. It's infinite, it goes on forever. The volume of interest is the real issue, not the annual percentage rates. So this is very important that you acknowledge and understand these things. Looking at the problem, here's a chart directly from page 17 of the 5th edition of Becoming Your Own Banker. So what Nelson is trying to show here is that of our expenses, a great portion of every dollar we spend goes to interest. Now, he's broken it down here. We have our automobiles, our housing, our living, and our savings. And just looking at the green on the far right, we're assuming that someone could save 10%. That's what the gurus recommend that we save. And we actually advocate that you save more of your money, you store more of your money into a place that you can access it later. But we'll get into that. But just for now, play along with me and assume that someone is saving 10%. As you can see here, that our living expenses are generally about 40%, our housing about 30%, and our automobiles about 20%. But if you take a little closer look, the red lines are the interest that we're spending. So about 5% on living, about 25% goes to housing, and another 5% goes to the automobiles just to pay the interest. So that's a total of roughly 35 cents of every dollar goes to interest. Now you might be saying to yourself, well, why is the housing showing 25% when I've got a 4% or 5% mortgage? Well, it's because it's not the rate, it's the volume. And if you just look at the interest that you pay over the first couple of years of a mortgage, you'll quickly find out that it's much, much greater than 4 or 5%, whatever rate that mortgage may have. So the interest is the problem, interest and fees, because as you know, there's many fees involved with our accounts, whether it be investment accounts or whether it be mortgage fees, closing costs, things of that nature. So this is the problem. Here's another problem, inflation. Our dollars are worth more today than they are in the future because of inflation. So this is actually a chart of the value of our dollar going down and inflation going up since 1913, the year that the Federal Reserve took over and now controls our money. We've got other problems. Taxes. This is a tax chart. Again, the IRS created in 1913, the same year, ironically, as the Federal Reserve. And as you can see, taxes have been as high as 94%. They stayed around that 90% mark for many years during the 40s, 50s, and 60s. So who's really in control of your money? Nelson said learning to control it is the most profitable thing that you can do over a lifetime. So we have to learn to control our money. It's not about the rates. It's not because the Federal Reserve lowered rates or whatnot, or we're earning a particular rate on our investment. There's also a lot of misinformation and a lack of education out there. The financial education taught in schools is funded and taught by the big banks and the corporations. It's like having the cat train the mice. That's from Robert Kiyosaki, author of Rich Dad, Poor Dad, and the creator of the game Cash Flow. So what is the solution? Well, we have to start thinking like bankers. But the good news is you don't need a degree in accounting, finance, economics, or business, let alone a master's degree or a PhD. Now, you've probably heard this standard advice. Buy term, invest the difference. Pay cash and prepay your mortgage. Diversify and invest for the long term. Dollar cost average. Pretty standard advice that I'm sure you've heard before. Well, guess what? Investors who follow this advice have lost tens of trillions of dollars in the stock markets just over the last several years. Many just this year alone. Many people have lost their entire retirement savings and they've had to return to work. So ask yourself, if that works so well, why do so many people struggle when we live in the most free and prosperous country in the world? We have to rethink our thinking. This means saving, financing, how we pay for emergencies, how we can invest in opportunities, how we make our major purchases. It requires thought and education. So here, I want to show you basically how we pay for things. The debtor, as you will note, if this is ground zero, the black line, and the red line indicates borrowing. So what the debtor does is they borrow money and then they pay back over time. Monthly or annually, they pay back that debt. Then what happens as soon as they get the car paid off or the credit card paid off, they go out and they borrow money again. This time it might be a loan. Could be a student loan. It could be another credit card, another revolving account. They get back to ground zero and boom, they borrow money again. They pay it back, they get back to ground zero. So it's a vicious cycle over and over. Here's the saver. They pay cash for everything. So what they do is they save money incrementally, maybe monthly, maybe annually, maybe weekly, whatever it might be. And they get up here and they've saved a bunch of money. Then they want to make a purchase, so they're going to pay cash. Now this money may have been earning interest, but now they're draining the tank. They've saved enough to pay cash for whatever it is they may purchase. Could be a car, could be a house, whatever it might be. It could just be a vacation. Then they start saving money again. They get up here. Again, the money may have been earning interest, but they have to drain the tank. So now it's no longer earning interest. They've paid cash, they're back to ground zero. They start saving again. So again, it's a vicious cycle. What I'd like to teach you is how to become a wealth creator. How you can actually have your money grow, compound, uninterrupted over time. So we have to save money, just like the saver. But then we can access our own capital to make the loan. And we have to pay ourselves back and be an honest banker. So now we're back on the curve again. And it takes a while. This doesn't happen overnight. It could take years, depending on how you treat your own bank, your own system for financing. So we'll borrow the money again. We'll pay the money back to our system. We put the money back in motion, right? And we use this over and over. So eventually we get above ground zero here, right? And now we're on our way. Our money is compounding exponentially, not just linear, okay? So our money compounds uninterrupted, even though we might be using our capital for purchases. Here's how they look all together. So again, we have to save money. There's no ifs, ands, ways about it. This takes time. It doesn't happen overnight. Some people can have this system up and running quicker than others, but anyone can do it. It just takes time and discipline. All right, so again, Becoming Your Own Banker is the book. This is no substitute. All of this is laid out in the book. But people tell me, maybe you've read the book. I hear things like, oh, times have changed. Interest rates aren't what they are. This book was written, 30 years ago originally. It wasn't really published until, I think, right around 2000, the turn of the century. But Nelson worked on the book for many years. And, so I often hear times have changed. It's all relevant to the time that we're in today. The concept in the book has not changed. We also hear, I'm too old. It doesn't matter when you start. You just have to start. I've had clients start at age 69. Many clients don't even start this till they're after 50. But the good news is you can start today. It doesn't matter if you're 18 or if you're 60 or if you're 70. You can start banking. Okay, let's take a look at family banking in action. Everybody wants to look at the numbers, and I'm not really a numbers guy, but I understand basic math, so I just want to demonstrate to you how banking can work for you. Again, there's many examples in the book, Becoming Your Own Banker, but since times have changed a little bit, I wanted to give you an up-to-date example. So in this example, over here we have family banking, over here we have traditional investing. All right, so we've got age 45 is where we're starting, so this is the end of year one. The person would be 46. We're taking them on out to age 65, so that's 20 years. The net annual outlay is the premium payment, okay? Over here, we have term insurance that we have to purchase, so that would be the premium payment there as well, okay? We're going to borrow money the same way, and we're going to repay it the exact same way. So don't let all of that, the numbers confuse you here too much. So $12,000 a year going in here for premiums, a total of $240,000. We're going to borrow money. So in year 5, we're going to borrow money from the insurance company against the policy, using the policy as collateral. Very important here. And we're going to take a loan for $20,000. The policy, you see the cash value in this column and the death benefit. All right. So the cash value has grown over the years. And in year 4, there's approximately $40,000. But the net after taking a $20,000 loan is $11,793. The death benefit has grown from approximately $350 to $391. All right. So we took the $20,000 loan. We're going to repay the loan at $6,000 a year, $500 a month. I can only do annually with the calculators here. But as you see, $6,000 going back to repay the loan. The last year, the 4th year, it would be less, okay, because that's all that's owed on the loan. So over here, same thing. Year 4, we took a $20,000 loan. We repaid it. The difference is, over here, we invested into another account this person did. Perhaps a mutual fund, perhaps an IRA. It really doesn't matter. $12,000 going in, $240,000 in there. Now, over here, you'll notice the cash value continues to grow other than the years that the loans were taken out. That's the net cash value, not the gross. That's after the loan. All right. So at the end of that time, $328,000 is in the account. We've made 3 loans in both accounts. Okay. We didn't borrow from the account here, by the way. We had to borrow money from the bank. We took a bank loan. All right. Because you can't get to this money typically, or obviously it will quit earning interest. So again, it's a taxable account, and we're letting it grow at 5% for this person. That's net after commissions or whatever fees that were charged on the account. Maybe it was earning 6 or 7, and so that is the net growth of 5%. This account grew to $416,631. This account grew to $328. We do have a death benefit here, though, of $788. Over here, you had a death benefit of $350, but it would go away at age 65, so there would be no term insurance left, but you still would have paid $27,100 into that account. You with me? So, this account looks a little better, maybe because it grew more. But over here, this money, once it was repaid, it went to the bank. There was no recovery of the cost there. It's gone. So that's basically how financing would work using a family banking policy, an infinite banking concept built plan. All right, so pretty simple. $12,000 going in every year for $240,000. So I'll show you the actual spreadsheet numbers here in a second so you can get a better idea. But roughly what I'm trying to get you to see here is that we're taking the same dollars and we're doing the same thing. We're borrowing money, only over here we're borrowing from a bank or a traditional financial institution, and over here we're borrowing against the policy from an insurance carrier, mutual insurance company. All right, so now let's take it a step further and talk about retirement. So when we talk about retirement, we're talking about distribution. We're talking about taking money out of an account. So Nelson didn't like to use the word retirement. He referred to it as passive income time. So whenever that might be, the government tells us that age is 65 today. Of course, it keeps going up. It used to be 60 and 62, 65, 67 now, depending on your age. And who knows what it'll be in the future. But for nice round numbers, just to make a comparison here, we're going to make it at age 65. So this person put in $12,000 and he's in a current tax bracket of 30, and we'll say he's going to be in a withdrawal tax bracket, whether or not you believe taxes are going to go up or down. We're just trying to keep things simple here. Okay, so 20 years of putting in that, it's growing at 5%. All right, and the amount would be $416. If you took that gross withdrawal, you would have to pay the IRS at that point $124,989, and so you would net $291,642. Now the argument is always, well, I wouldn't take all that money at once. Well, it doesn't matter if you take it at once or you take it over time. The numbers are the same, but I'll show them to you here. So here we are at age 65. And we're going to say this person is going to live to age 90, and we're not going to inflate that amount that we're putting in there. So it would grow again to the $416,631. It's going to be 100% taxable. Again, the tax bracket we're just going to assume is 30%. All right. So here is the gross withdrawal, age 65. Okay. We're able to take out $16,665, and the tax rate is 30, so they would pay $5,000 tax, and they would net $11,666. All right. Now we're using a 4% withdrawal rate. Why are we using that number? Because that's what traditional financial planners tell you you can use. That's a safe withdrawal rate. Well, it has been for many years. That was a very famous study done by, I believe his name was William Fowle, PhD economist, and it was also published in Morningstar and many other publications. But they said that safe withdrawal rate is 4% is what you could take out. All right. Now, we also have to assume that it's growing at that rate as well during retirement. People are usually a little more conservative at that time. And again, we're taking them on out to age 90. 89 would be through, just to give us the full 25 years, 65 through 89. Okay. So again, after 25 years, it grew to 416. But there's major risk here. The first risk is we don't know what taxes are going to be. Most people assume taxes are going to go up, but who knows? I mean, we just spent, trillions and trillions of dollars on this stimulus plan. They don't even have a total yet. We won't know. It'll probably be more. What you need to understand is we already have $23 trillion of debt this year. Our unfunded liabilities are well into the hundreds of trillions of dollars if you include Social Security and Medicare in those numbers. There's some other risk, inflation. What happens if our dollars are worth less because of all of this spending? What about the interest rate? What if we can't get 4%? What if, markets are low, rates are low as they are today? What if you lose money? What if the markets crash? What if something else happens? Okay, I don't know where else you're going to get 4% unless it's in the market today. Other than what we're talking about here, life insurance, I don't know where you get close to that number. So there's market risk. And then there's longevity risk. What if this person lives past age 90? What if they are still alive? Where does that money come from? Again, we're assuming 4%, but if you look at today's numbers, the Wall Street Journal and Morningstar both redid those numbers, and it's more like 2.6%. So I'm being generous in this example. So the net spending after taxes was $291,642. So again, that's what I showed you over here. All right, and as you see, after all that time, that was the net spending purchasing power of that money. Now, let's compare this traditional retirement account, okay, to family banking. I've already showed you the financing, and let's look at it during retirement passive income time. So over here, we've got the saving, and over here we've got the investing. All right, so saving, we paid premiums of $240,000. We took loans and we repaid them, okay, with interest at $66,708. The loan proceeds were $60,000, and the cash value at that time, after the 20 years, was $328,056. So there was a net gain of $81,348. All right, over here we invested. Okay, we had to pay term premiums, $27,100. We put in $240,000, the same, $240,000. We took loans. We took loan proceeds, same. Okay, but the account here was $416. So we grossed the gain. The total was $142 if you just add and subtract those numbers. So over here, the investing account looks a little better. But we're not taking into account something called taxes. All right, so let's get down here and let's look at what the financing did. All right, so we paid the premiums, we invested, we took loans, we took out loans. There's no death benefit at age 65. Okay, it's gone. The term went away. The account value $416,631. You took the taxes out, and so the net was $17,834. Over here, the net is $541,924. Now that does not include the death benefit, okay? I'm sorry, it does include the death benefit. So if you died at age 65, that's what your family would get, all right? So it obviously is a little better if you consider that. Now we don't know when we're going to die, so the death benefit over here would have been $350 if it's before that time. All right, so this is the account here, but let's look at let's look at the retirement account, and the income, net income, $18,000 a year, $450,000, $18,000, 25 years, tax free. Tax free. Again, these are loans against the account, so there's no taxes on loans. $450,000, but because we were taking loans, it did decrease the death benefit. So the death benefit at age 90, after 25 years of income, $314,644. All right. Over here, we took the $16,665 for 25 years, so that's $416, the same number I showed you earlier, and we had to pay taxes on that. All right. So the net $291, just rounded to $650. Okay, I think it was $642, right? So $650. All right, so we have to consider there's no death benefit. If you died anytime after age 65, the death benefit would be $0. And of course, there would be money left in this account, hopefully, at that 4% if we never had to dip further into the principal. But we don't know what that'll be because we don't know what the return would be. Again, these are the risks. We don't know what any of these numbers will be. They're major risks. We don't know what taxes will be. We're assuming they're going to be 30. We don't know what inflation will be. We're just assuming zero inflation. We don't know what the interest rate we'll be able to earn on the money. We don't know what the, really the distribution rate is. That's just a number that they've come up with. You could lose money. Obviously, there's market risk, and you could live longer than age 90. Okay, so if you died anywhere after age 65, just understand there's no death benefit with that term policy. So back to the numbers over here. If you just added all that up, the cumulative gain in the family bank after we took income of $450,000, okay, for 25 years, all right, we paid premiums of $240. So that's a cumulative gain of $210,000. And again, that's after we used it for financing our entire life. We financed, again, 3 purchases, okay? $20,000 3 times, $60,000 total, okay? So here we are. We took the loan proceeds, all right? So that's where we come up with these numbers. $450,000 was the net income because there's no taxes. The premiums we pay were $240. So again, the cumulative is $210,000 to the positive. Now, if we died at age 90, after all of those loans, our family, our heirs, our beneficiaries would still get $314,000. So you add that to the 210 for a net gain of $524,644. Okay? Again, the death benefit and the net gain after the loans and the premiums and everything were paid. Over here, we're at, again, the spendable income was $219,650. There is no death benefit after age 65. The term went away. That money is gone forever. Our family will never see it again. We had to pay taxes. We don't know what our estate would be at the time. It will have to go through probate probably. Over here, we bypass probate. The death proceeds are tax-free. They go directly to the beneficiary. So that's how family banking works, not only for loans, but during retirement passive income time. So infinite banking is the solution. Nelson said banking is the most important business in the world. That's a direct quote from Nelson, author of Becoming Your Own Banker. And what we're doing here is taking control of our money. We're in control, not the banks, not the government. Okay? So why use life insurance? Okay, people always, life insurance has been beat up so bad over the last 20, 30 years, but life insurance has been around for centuries. Okay? That's why we use it. It is the cornerstone of your financial plan, any financial plan, right? We have to assume that we are going to die at some point. Okay, nobody wants to die early, but you never know. I personally have had 3 family members die before age 70 in my family, direct family. My stepdad, my dad, and a stepsister killed in a car wreck. So that's in my direct family. So why life insurance? Well, life happens, just what I told you. There's car wrecks. There's heart attacks. Things happen. There's expenses. There's college. There's marriage. There's weddings. So life happens. We don't know when, but the picture here illustrates a Swiss Army knife. Life insurance works like a Swiss Army knife. It gives you multiple uses of the same dollars. Your dollars work harder. They're not just the death benefit, as we've been told. This is how you can use your life insurance while you're alive and still leave a benefit for your family later. It's time tested and proven by the corporations and the banks. You see them here, okay? These are their respective logos and trademarks, but they all have used life insurance. Here's the dirty little secret. Banks own more life insurance than anyone. It's called BOLI, bank-owned life insurance. They'll never tell you that. They don't want you to know. But here's just an example. This is a partial list of the major banks that's taken directly from the book, The Pirates of Manhattan. I highly recommend you read that book if you get a chance, by Barry Dyke. And these numbers are probably 10 years old at least, so they've increased dramatically. But as you see here at the top of the list, Bank of America has over $13 billion of cash value bank-owned life insurance. So you'll see Wachovia here, which is no longer around after the great debacle in 2008, 2009, Wells Fargo now, but as you see, they owned $12 billion at that time beforehand. So these numbers, I think it's around $24 billion today. Bank of America owns JP Morgan Chase, Citibank, Regions, and where I live here in Mississippi, Bancorp South, 168 million. Again, these numbers are much more today, and you can check them on the FDIC website. This is public information, but bank-owned life insurance, if you want some fun, just Google that. All right, so banks like loaning money. We call it the velocity of money. You make a loan, you pay back the loan, the bank loans out the money again. They're having their money work over and over again. That's what I'm trying to illustrate to you here, that your money can work for you over and over again using the infinite banking concept, family banking. All right? So start your family banking system. Have your money work harder. Get multiple uses of your money. It will protect your family and business from day one. You can use it to finance your purchases while your money continues to compound uninterrupted. It can grow your wealth. You can leave a legacy for your family or heirs. So how do you start your family bank? Well, it's real simple. 1, 2, 3. Number one, you need to read the book, Becoming Your Own Banker. If you have not done so, please get a copy of this book. You can read it. You can share it with your family. You can use it. You want to read it over and over. The second step is just take action. You want to apply with an IBC practitioner, somebody else that is actually doing this, a licensed professional that understands infinite banking. The average advisor, agent does not understand. Again, I teach this to advisors every day, just like I teach it to families. And you want to work with somebody who understands it, somebody that's practicing this herself. And number three, you want to follow the infinite banking concept rules. There's basically 4 rules. You can also view all of those rules on my channel, Legacy Money. So that's how you get started. It's really not that complicated. I've taken a lot of time just trying to slow it down, but it does take education. So be sure to do that. That's how you get started. Why wait? Time and health are 2 precious assets that we don't recognize and appreciate until they have been depleted. That's from one of my favorite authors, Dennis Waitley. So don't wait. I want to thank you for joining me, and I'll see you in the next video.